Bill Winters, thank you so much for joining us. This is in the city. Dave and I are in New York.
In New York City.
Earthshot, there's UNGA, there's a lot to talk about, especially like climate transition, financing, and the role that banks have in all of this.
Absolutely, and who better than Bill Winters, Chief Executive of Standard Chartered. We thought we'd range around the world really to get your lens on everything that's happening, but maybe kicking off, because we're here at the Plaza where we've had the Earthshot Prize, talking about this question of climate finance. And your involvement with Standard Chartered, what's the state of the industry?
Well, we're very involved, I think is a short summary. And look, I think at this point, most rational people understand the problem. I know there's still some naysayers, but they're few and far between right now. Although you probably don't have to spit too far from this building right now to get a few of them. But the challenge is getting the right programs in place that can make the most difference. And then, of course, as always, the money. What's clear is there's no shortage of money. There's plenty of money available, and it's not just general money. It's ESG money or sustainable finance money or transition finance money that's available. But I wouldn't say it's highly sophisticated in the sense that it's not geared up to do the heavy lifting around oftentimes quite complicated projects.
But Bill, it was my understanding that there's a pool of money that actually needs to go to the transition, but actually that pool of money is maybe not as committed to it as it was 4 or 5 years ago. I don't know whether it's crises or whether they have other priorities, but that there's money, but it's not necessarily going to where it needs to go.
It's an open question, and in a way, I wish we knew for sure that the money was less committed, but I think we've got a problem before we even get to that point, which is coming up with the right projects that have the right assembly of risk takers. And by that I mean a project for reforestation in the Democratic Republic of Congo. There's a lot of political risk. There's the technical risk of surveillance and monitoring. There's the use of what's the money actually being used for? Is it being used for what was intended? Bribery, corruption, et cetera. And so before you even get to the point of delivering the money, you've got real technical problems that have to be overcome. And the good news, I think, is that everybody's kind of aware of this, and a big part of what's going on this week in Climate Week will be things like Ajay Banga at the World Bank, who are very focused on saying, there are some risks that we're really best placed to take, and we've got money set aside to do that. And we can provide catalytic capital. We can take some of the risks that a private sector financer just can't handle, or hasn't yet been able to handle. Take them off the plate, and then allow the market to come in and do the heavy lifting behind that initiative. So those things are happening, and that's what we're talking about this week. But it hasn't happened yet. But to your question, is the money less committed? First of all, money's always committed to things that generate a decent return, right? I mean, if we can offer a decent return, risk-adjusted return, there's plenty of money. And I think the only way that we're going to be successful in the fight against climate change is to offer people an acceptable return. It doesn't have to be a grotesque return, just acceptable. That's the only way to move trillions and trillions.
I mean, Climate Week, I guess alongside COP, is the big sort of global gathering for people to come together and try and think of solutions. Do you see this week as achieving any of that? Everyone's here in New York. They're tackling the problems that you just outlined. Do you think we'll see some progress this week to fixing some of these issues?
I think so. I understand there's 100,000 people that have come to New York Climate Week this week. That's an impressive number of people. And nobody comes here to be seen. It's not something where you show up and flash a card and say, okay, I've done my bit. You come here to solve some problems. So, I mean, just in the course of my time here, we've had discussions with the GFANS group, which is a Mark Carney initiated gathering of financial companies, focus exactly the question that Francine you asked at the outset. How do we get this big block of money actually put to work? It's nice to talk about it, but until it's spent, it's not doing any good. To some really creative ideas from the Minister of Finance of Brazil, is promoting a fund to effectively fund the preservation of rainforests around the world in a very creative way, using public and private sector money in a creative constellation. I think those opportunities where you're ideating, maybe a slightly overused term, but thinking through how do you make something work. When you're sitting in a room together, you actually come up with some stuff that you don't necessarily see on emails or even a Zoom call.
And Standard Chartered is going to be a leader in this process?
We are a leader.
You already are?
We are a leader, but we're a leader for a good reason, a kind of obvious reason. One is we operate around the world, but major on-the-ground footprint is in Asia, the Middle East, and Africa. And when you look at the parts of the world that are going to be most affected by climate change, whether it's 50-degree plus days in central India or floods affecting Bangladesh, two of our biggest markets, our markets are going to be most affected. So if we don't do our bit to avoid the worst case outcomes, we'll have some challenges ourselves. But the flip side is the impact of a call it renewable power technology, or it could be adaptation financing in some of these markets is much higher than anywhere else in the world. So a dollar spent decarbonizing in India is the equivalent of $7 spent in Europe. Why? Because Europe is already largely decarbonized, and the US is someplace in between. So the markets where we operate have the least access to finance and the most impact of an invested dollar. But I want to be clear, this is business for us. So we're doing the right thing. And we're doing the right thing because our stakeholders, starting with our own employees, require it. But we've said publicly we're going to make $1 billion in this business income next year, and I think that'll go to 2. That'd be 10% of our income or something like that. So it's this is to my point that if you offer an acceptable return on capital or return on effort, you'll get a lot of capital and effort involved.
But Bill, you also understand this, more than most because you were part of the task force. You understood, you were like a regulator before. But what do you think is the purpose of financing this? Because there's a step back from a lot of the banks and saying, look, we should not be leading the way. We should be enablers. We should be facilitators, and it's really up to the policymakers and the politicians to then use us in the correct way. And that changes actually how much can be done around the world.
Look, I think in some ways it felt like we started with governments or other stakeholders, shareholders in some cases, saying, you need to do this.
Right.
And banks and other companies said, okay, we don't want to, but we will. That's never going to work. Right? That approach will never work. The second approach that will never work is expecting governments to fund the trillions of dollars necessary out of taxpayer money. It's not going to happen, right? It's just not going to happen. So if the private sector, broadly defined, isn't funding this, with appropriate impetus from governments, we can definitely get this done. But the fact is, carbon in the environment is an external cost. It's a real cost. We're going to pay for it. If not us, then our children or grandchildren. We're going to pay for it big time. Price it properly. Price it properly. There's different ways to do it. The Europeans have said we're going to tax you on your carbon emissions. We're going to limit the amount you can emit, and then you can trade the credits back and forth. It works. But the cost of carbon in Europe is $60, $70 a ton. The cost of carbon in California is $2 a ton. I would argue that good idea. It's not working. But if governments around the world put a carbon tax in place at something that represents the actual external cost, there would be no climate change problem. Why don't we do it then? Because it's hard. Who wants to tax your population? You don't get elected.
Everything's hard.
Life is hard. So. But what's not hard is to make good investments in sound things that generate a return for your investors and carry on from there. That's what Standard Chartered is doing.
How much of your time is spent on this topic? I mean, you said it might reach 10% of your total revenue base. Sounds like you're spending a lot of your time thinking. You're in New York for Climate Week. Is it eating up a lot of your focus to how you position yourselves in this?
To me, it's important because I do think that corporations have a responsibility to the communities in which we operate. It's very important to our clients. So, I mean, there's no client meeting that I have these days where the topic of sustainability or net zero transition doesn't come up. I mean, literally, it never fails to come up. Mm-hmm. With any CEO, any CFO, any treasurer I talk to, it comes up. Sometimes it's the whole conversation. Why does it come up all the time? It's not because they're trying to make me feel good because I've invested some time in this. It's because they care about it as well. They have stakeholders. Frequently, it's your own employees. Certainly for consumer goods, it's your customers. I mean, the real leaders in the consumer products area are marketing their greenness like crazy, and they're right to, because it's costing them something, and their buyers should know, the consumers should know that this effort has gone into that. But so it's not a disproportionate amount of time, I don't think. But
what else comes up in those meetings?
What else?
Inflation, the economy. Politics?
At Standard Chartered Bank, more often than not, it's China. What's really going on in China?
What is really going on in China? We had this massive stimulus today.
I don't know if it's massive, but it's
bigger.
It's a start,
and it's a big change. It's a big change because
change.
they've been very incremental so far. And I think it reflects the reality on the ground, which is that consumer confidence and investor confidence is quite low in China. So the government has properly gauged that they need an impetus. And I think a lot of things are going on in China. We know that geopolitical tensions are in the backdrop. We know that China has built up excess capacity in a lot of the new economy industries, sustainable infrastructure and EVs and associated components. And we know that the rest of the world is beginning to say, hold on, we're not sure we want to take all that because you're a little bit too good at this. So Europe and the US, for starters, they're in the process of shutting down big chunks of their market. Now there's a broader question around how do we feel about these major impediments to global trade. Everybody loses when we cut out trade, but I won't veer into the political because of course there are motivations that go beyond just promoting free trade. But I think China is going through a massive transition from old economy to new economy, from massive investments in property and infrastructure into massive investments into the new economy. They will succeed in that transition, right? I mean, they've got the technical competence and the know-how, but they're meeting a lot of barriers along the way, and it's a tough transition.
Will it take longer? I mean, they will succeed, but it'll take longer than they're expecting, which means more bumps on the road.
I think so. And when I reflect on the major transitions that we've gone through in the US or in Europe or Japan or Korea, they were almost always associated with major financial crises, and sometimes multiple financial crises. And I think China, of course, sees this. They've had their own financial crisis if you went back to the 90s. And it's hugely destabilizing economically. It's also destabilizing socially. It leads to inequality and miscontent and malcontent. That's a big issue for the Chinese leaders. So I think they're determined to avoid that kind of a financial dislocation. But that means it's going to take longer.
Is that enough, like a determination to prevent it? Is that enough to, I mean, it's been a terrible year for Chinese stocks. People have lost a lot of money, the bears are there. Yeah. These measures you said, or you implied, they're probably not going to be enough. Does the government have enough firepower to prevent a much bigger crash happening in the Chinese economy?
I think the government has a lot of firepower. So there's a lot of rhetoric around aggregate debt levels in China. I mean, debt levels are concerning, but the economy, even despite the current woes, is still growing at probably 3.5% to 5%. 5% look more likely right now, as it's trending more towards 3%, but let's just say it's going to settle at 4.5%. You can run a meaningful budget deficit with 4% GDP growth and not have the kind of spiraling of debt levels that we have, for example, in Europe, or that we had in Japan during the lost decades. So I think China has a huge amount of fiscal firepower, and as they've shown today, they have a lot of monetary firepower as well.
But is there a danger that their economy is in a certain way, which is very skewed towards industries that are not doing very well? They need to add, I guess, 30% in value add if they want to transition to a better, healthier economy. So by stimulating too much now, they can't get to the economy they want in 4 or 5 years. I mean,
I think the single most important thing for China is to restore consumer confidence, because the savings rate in China is astronomical. And we know why. In part, it's that it's a largely unfunded health and pension system, so people are just saving for their needs down the road. But also because they're not sure that they're going to have jobs, and youth unemployment is quite high. And these aren't unprecedented problems by any means, but they need to take the action to jumpstart confidence, to get the spending up, and then to get businesses to start investing again in the domestic economy, not just for export. We're finding that just for export, it meets resistance.
Can we talk a bit about Britain? We've just Britain. We've got a new government in place, and
still new.
They're still there for now.
3 months, right?
Yeah,
but the honeymoon is over. Right?
The honeymoon was the shortest honeymoon, I think, in political history. But they're talking a lot about the need to stabilise the economy. Tough decisions coming up. We're all waiting for the budget, the Rachel Reeves budget. What's your lens on the state of the British economy now from your perch as running one of the big banks?
It's tough, right? I mean, we have been through 10 tough years, and
right. So tracing it all the way back to the Brexit turmoil and
definitely Brexit. I mean, you're dragging me into politics, but that was, I mean,
just economically.
With the benefit of hindsight, that was a gigantic own goal.
Yeah.
Some would have said, with the benefit of foresight, that would be a massive own goal. I happen to be one of them, but that doesn't matter because that's not the way the election came out. But
But do you think this government is one that's going to back business? I mean, there are some doubts emerging, aren't there? We had a big story last week talking about the hedge funds, the wealthy who are planning to leave Britain. That is never a good sign for a government. And that's even before the budget's come out. I mean, is that what you're hearing from the clients?
My sense is that the government is taking an extremely pragmatic approach to engaging with the business community broadly, with finance in particular. And you know, we've seen some concrete things like the outcome of the Basel 3.1. I think it's quite technical, but you know, at the end of the day, there was a prospect of increasing the capital requirements on banks by a substantial amount of money. And I think without compromising financial soundness or prudential regulation, they put quite a pragmatic set of current proposals on the table. And that was, of course, it was led by the governor of the Bank of England and the head of the PRA, but the chancellor was there when it was presented to the banks. Right? And to make it clear, we're paying attention. And by the way, the government, it's actually, as it happens, it was the previous government, but this government has embraced it completely, the idea that regulation should be in support of financial stability, but also competitiveness for the City of London. So I'm encouraged by the pragmatism, but nobody harbors any illusions about the challenges that this government faces. Fiscal, monetary, I mean, obviously the Fed has cut rates, the Bank of England didn't. There's a reason. Inflation has been stubborn on the upside. So there's nothing easy about the predicament in which the UK finds itself. I only know that Britain's been around for a very long time. It's incredibly resilient.
That's a low bar, Bill. What do you need from the government? What do you mean it's been around a long time?
Well, it's been around for a long time. I mean, it's amazingly resilient. People bounce back. You know, governments figure out the right thing to do. Look, the budget's going to be tough. It's not going to be an austerity budget, but it's probably going to feel like an austerity budget, just because that's the way it's going to pan out. Not completely unlike China, the UK needs to reinstate confidence so that the businesses are comfortable investing in Britain. And everything that I've seen so far is supportive of that, right? But the heavy lifting is yet to come, I know.
There's a lot of speculation. I mean, no one knows which is going to put the budget. There's people talking about capital gains tax, carried interest, people taking fright, but we're going to have to wait and see, aren't we, what she actually does? Yeah,
but again, these issues can be very emotive, I know, for everybody. And of course, they're very economic as well, but not a lot of money involved. Right? I mean, if I read on Bloomberg News the most draconian approach to taxing private equity carried interest would generate £500 million of
right.
It's not nothing, but this isn't going to solve the problem.
No.
And of course, what you don't want is.
So it begs the question: why bother? I suppose, but it's a political.
I think this government, as the previous government, took it on as an issue of fairness. Like,
right.
Just what's fair. Like, I thank God I'm not a politician. I'd be terrible, because you've got to balance these different constituencies and stakeholders. But what I've seen with this government is that they're pragmatic.
Are you still frustrated with your share price?
I'm always frustrated with my share price. Yes, I am. But
it's in a better place than it was.
Yeah,
a year ago.
Yeah, better today than yesterday, and but the things that we can control as management, first order, are service to customers and ability to translate that into value for shareholders. Right? By those measures, we're doing really well. So I'm very happy with our financial performance, and that will the outlook is bright, I would say. And the second order is we got to convince the market that they should be as comfortable with our earnings stream as we are. I feel like we've fallen short on that.
Bill, there's a lot of M&A talk in Europe. Well, not a lot, but there's
one deal.
and Commerzbank.
Yeah.
But every day there's talk about that deal.
Yeah.
Is that exciting for you if there's M&A
I think it's
Europe?
very necessary in Europe, and because Europe is overbanked, and growth is relatively low, and banks at this point are well capitalized and healthy, so it's necessary. But if we needed a reminder how difficult it is, the fact that, as far as I can tell, UniCredit is following the rules, and German politicians and German unions have said we don't like this. Now, maybe it's posturing, or maybe it's a real obstacle. I don't know, but it's tough. It's tough to get things done within Europe.
Is it a test? I mean, if this goes through, if the rules are followed, and if this goes through, would it make you confident that actually things are moving in the banking sector?
I think it's a really important litmus test. Not the only litmus test we could have, but there's industrial logic to the transaction. There's a willing buyer who has plenty of capital to make this kind of, and there's a healthy but not thriving bank on the other side, and Germany's overbanked. So it would seem, And of course, UniCredit owns a very big bank in Germany, so it seems to make sense. But these things, they get political and then it gets complicated.